So you're thinking about ETFs for 2025. Smart move. But let's be honest, it can feel like you're staring at a map with 1,000 different roads, right? Well, today, we're going to unfold that map together and find a really clear path for your portfolio.
You know that feeling? You open an investing app and it's just a wall of choices. You are absolutely not alone. There are literally thousands of funds out there, and trying to pick the right one can feel completely impossible.
But what if you had a simple guide, a map really? That's exactly what this is. We're going to break it all down, step by step. We'll start with the biggest picture imaginable, and then we'll slowly zoom in on the details that actually matter to you.
All right, so where do we even begin on this map? Well, the simplest and honestly one of the most powerful places to start is just to own a little piece of everything. Let's dive into global index funds.
Okay, so what is a global index fund? Think of it as the ultimate lazy investment. In a good way. It's not trying to be clever and pick winners. Nope. It just buys all the biggest public companies in the world, sorts them by size, and that's it. It's the perfect foundation for a portfolio, giving you a slice of thousands of companies across the globe.
So, what does this look like in practice? Here are two really popular options. You've got Invesco's FWG. It's kind of the new kid on the block, with a really competitive fee of just 0.15%. Plus, it's accumulating, which is just a fancy way of saying it automatically reinvests your dividends for you. Super simple. Then you have Vanguard's VWRP. This one's the big established player. It's a tiny bit more expensive at 0.22%, but hey, it's been around forever and has a ton of money in it, which, gives some people a bit more peace of mind. Okay, so that's the whole world. Now, let's zoom in on our map. We're going to focus on the biggest single chunk of that global market. Yep, we're talking about the good old USA. And here we have what is probably the most famous stock market index on the planet, the S&P 500. This is your ticket to owning a piece of the 500 largest companies in America. I mean, we're talking about all the big names you know, you love, you use every single day. Now here's where it gets really interesting. Check out the cost. Vanguard's option, VUAG, is already dirt cheap at just 0.07% a year. And yeah, it's also accumulating, so it handles reinvesting for you. But then, look at the State Street option, SPXL. The fee is just, wow, 0.03%. That is less than half the cost of the Vanguard one. And trust me, over the long haul, that tiny difference in fees can add up to a huge amount of money.
All right, staying in the US, but maybe you want to sharpen your focus a bit. Let's talk about the NASDAQ 100. Now, this isn't the whole market. This is a very specific list of the 100 biggest non-financial companies on the NASDAQ exchange. And what does that mean in reality? Well, it means it's all about the tech giants.
And this chart, wow, it just shows you how focused it really is. When you buy the NASDAQ 100, you're not getting a hugely diverse basket. The top 10 companies alone, we're talking Apple, Microsoft, NVIDIA, all the big guys, they make up a whopping 50% of the entire index. So yeah, if those giants have a great year, you're golden. But if they stumble, it's going to be a bumpy ride.
Okay, let's zoom back out from the US and explore a totally different part of our world map. Let's look at the places that have this reputation for massive growth potential. We're talking about emerging markets.
So, what are emerging markets? Well, we're talking about massive economies like China, India, and Taiwan. Now, they only make up about 10% of the entire global stock market, but a lot of people think they have just incredible potential for growth. But, and this is a big but, that potential comes with a whole lot more risk. You got to be ready for a much bumpier ride. So, if this is a corner of the map you want to explore, you've got options like Vanguard's VFEM. But take a look at that fee, 0.22%. See how that's higher than the S&P 500 funds we just looked at? That's not an accident. It just reflects that it's more complex and, frankly, more expensive to invest in these markets. It's just a perfect little reminder that you always have to keep an eye on how fees change depending on what you're buying.
Okay, quick recap. We've gone from the whole world to the US to emerging markets. Now we get to the most zoomed in, the most specific, and yeah, definitely the riskiest part of the map, betting on individual themes and sectors.
This is where you find all the trendy stuff, right? Funds focused on AI, robotics, semiconductors, you name it. But you have got to be careful here. These are so much more concentrated than a big, broad index fund. And here's the kicker. Even if they've had an amazing run lately, that tells you precisely zero about what they're going to do tomorrow.
And this point is so important. I really want this to sink in. Chasing the fund that was #1 last year is one of the oldest mistakes in the book. It almost never, ever works out. Today's hot fund is very often tomorrow's big letdown.
Okay, so we've explored the different territories on the map. But how do you learn to read it for yourself? Let's give you a simple toolkit, a sort of investor's compass for doing your own research on any ETF you come across.
It's basically a 5-step checklist. It's super simple. Number 1, are you buying this on the right exchange in the right currency? You don't want to get hit with extra costs. 2, how are the fees? Are they competitive? 3, is this fund big enough? Does it have hundreds of millions or even billions invested in it? 4, how does it actually hold the stocks? And finally, number 5, and this is maybe the most important one, what is actually inside this fund?
Let's just touch on that fourth point for a second, replication. Physical replication is exactly what it sounds like. The fund manager goes out and buys the actual shares. Synthetic is a bit more complex. They use financial instruments, things like swaps, to just copy the performance. Now, personally, I always lean towards physical. There's just, a bit more peace of mind knowing the fund actually owns the real thing.
Which brings us right back to step 5. You have to scrutinize the index. Look at what's inside. And this is a hilarious real-world example of why. Somebody found an ETF that was called something like AI and Big Data, and its top holding was Bank of America. Does that make any sense to you? Because it makes no sense to me. And that is exactly why you have to pop the hood and look inside.
So, here's the big takeaway from all this. The name on the fund, the label on the tin, it doesn't always tell you what's actually inside. You cannot just trust the marketing. I don't care if it's a huge global fund or some tiny niche one. You always have to check the holdings and make sure you're actually buying what you think you're buying.
So there you have it. We've journeyed across the entire investing landscape, from owning a piece of the whole world all the way down to betting on a single, tiny idea. And now, you have the tools to explore on your own. You've got the map, you've got the compass, so the only real question left is, what are you going to build?